It seems like everyone on social media nowadays is talking about Roth IRAs, Roth conversions, backdoor Roths. Hey, that's all good, but what no one is talking about is that one IRS rule that can change your tax-free conversion or your tax-free rollover into an unexpected tax bill. And it's called the Pro Rata Rule. And if you have ever rolled an old 401k from an old company, old employer into your traditional IRA, or you're thinking about doing a backdoor Roth or Roth conversion, you need to pump the brakes. And we need to understand the big picture before you even think about moving money. So today, I am bringing you the full Roth roadmap. So grab your coffee, fill the gas tank, we're ready to rock and roll. All things Roth, Roth IRAs, backdoor Roth, Roth conversions, Roth chunking, the Pro Rata Rule, all explained today with real life case study examples. Guys, it's Mike back at it from Ledgerly, CPA, tax strategist, co-founder alongside Andrew D'Amico, here to answer one of the most common questions from W-2 earners and business owners alike. Should I be doing something with Roth? So before we answer that question, make sure you smash that subscribe button. Welcome to the Ledgerly family and stay tuned for more videos like this one. So to answer that question, yes, you should absolutely be doing something with Roth. We love Roth. We preach Roth. Roth is gospel to us at Ledgerly and to a good tax strategist. However, the bigger question is, are you doing it strategically? There's no impulse buying when it comes to Roth. We got to make sure we have the right fit, the right candidate, and we're doing it the right way. There is a massive difference between saying, hey, I have a Roth and I have a Roth strategy. Let's get into it. So overall, high level, why Roths are worth the conversation, why they're worth it. So unlike a traditional IRA or a traditional 401k where you actually get the tax deduction, and then when you pull it out later, you're gonna pay tax, a Roth is the inverse. You are putting after-tax dollars in, so you're not getting a tax deduction. You're actually paying the tax now, and then everything you put into the Roth account is gonna grow and grow and grow. And then later, retirement, every qualified distribution you take is tax free. And the cool thing about a Roth IRA, unlike a traditional IRA, is let's say over the course of 10 years, you've put in $5,000 per year. So your basis is $50,000. Let's say it grew to $100,000 and we're well before retirement age. We can actually take out our basis, which is that $50,000 penalty free tax. You basically have a loan outstanding to yourself. We can't touch that earnings yet, but we can take out the principal that we've put in. Now, for most individuals, contributing directly into a Roth IRA is easy. It's clean. It's simple. The problem occurs when your income reaches that certain threshold limit and it triggers phase outs. Now, we're not going to get into those numbers because those numbers change every single year. So you watching this video, we're filming in 2026. I want you to watch this 10 years from now, as long as Roth IRAs don't go away, and still be able to apply the exact same technical information that we're talking about in today's video. So once your income reaches that certain level, let's call it 150,000, which is basically the midway point between what it's currently, then you're phased out. We can't contribute directly into the Roth IRA. And that's where a bad tax advisor or just your compliance accountant will say, oh, you make too much, Roth IRA is off the table. No, 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 wrongo, as Jim Carrey would say. We can't contribute directly into the Roth, but we can sneak through the back door, baby. That is where the backdoor Roth comes into the ballgame. So what is the backdoor Roth? It's not some type of product your financial advisor or we're selling you. It's simply a process, and it's a two-step process. Step one, we make a contribution to a traditional IRA, but it is a non-deductible contribution. We are not taking a tax deduction for that contribution, meaning the money we're putting in, no tax deduction. It's post-tax dollars. So that's step one. Basically, that's day one. That's on Monday afternoon, we are doing that. Step two, on Tuesday afternoon, we are going to convert that traditional non-deductible contribution over to Roth. Enter the back door. Now, on paper, seems simple, right? You already paid the tax on the money going in, so the conversion to Roth should be clean. Wrong. This is where most people, and in fact, most influencers on TikTok will say, all you got to do is the backdoor Roth. That's where they're wrong. They miss one major piece entirely, and that is the pro rata rule. The IRS doesn't look at that one account that you are contributing into and then converting. No, no, no. They look at your entire IRA buckets in entirely, all of your traditional accounts. So think of all of your traditional IRAs as one giant bucket. Traditional IRAs, SEP IRAs, simple IRAs, anything, the money that you put into these accounts, you receive the tax deduction. For example, let's say you have an old 401k from an old employer you used to work at, and you rolled that 401k, assuming that 401k is all traditional dollars, meaning put the money in, you got a tax deduction. You took that old 401k and bloop, you plop that into your traditional IRA. Basically, just a conversion. Maybe you paid $50 to bring it over to your IRA because you're no longer at that employer. You can make more money in your own IRA. So we got that old 401k into our rollover IRA or rollover traditional IRA. And let's say you had another traditional IRA on top of that. The IRS looks at both of those buckets as one. Now you're at a new job. Maybe you're a business owner and you are over that threshold. So we need to do the backdoor Roth. So you go to do step one, that non-deductible contribution, and then you go to roll it over on day two to the backdoor Roth. Most individuals, most people on social media will say, yep, that's good. However, that's where that pro rata rule comes into play. The IRS says, no, 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 no. Before we can even do that non-deductible contribution and roll it over, convert it into Roth, we need to take care of your traditional bucket first. So let's say that old 401k that you rolled over was $90,000. And let's say that traditional IRA that you have sitting there is $10,000. Combined, we have $100,000 of traditional IRA monies that need to be taken care of in order for your backdoor Roth to work. So let's come back to that $100,000 bucket that we have of traditional dollars. Now let's say this year we want to do that backdoor Roth conversion. So day one, we do, let's say $5,000 into the Roth. Well, not Roth yet. It's actually non-deductible contribution. We do $5,000. Then on day two, we want to roll that over into Roth, right? So that's $5,000 added on top of our $100,000. That's $105,000. Essentially, 95% of our total bucket is traditional dollars. Now, I'm just rounding here, meaning that when we convert that $5,000 over to Roth, we're going to pay tax on 95% of that conversion, which roughly comes out to $4,700, right? So $4,700, that dollar amount, we are going to pay tax at whatever our marginal bracket is, call it 22%, 24%, whatever it might be. So that's not going to be a tax-free transfer because we have those traditional dollars sitting there, the pro rata rule. So in order for those conversions, the backdoor Roth, the Roth conversion to be tax-free, we have to take care of that $100,000 that we talked about, the old 401k in our IRA, $100,000. And there's two ways to do that. Option one is called the reverse rollover. So if you're at a new job and you have a 401k at that new job, you can see if your current employer's 401k plan accepts reverse rollovers, which is basically moving that pre-tax money, that $100,000 back into the 401k plan. And why does this matter? Because 401ks are generally excluded from the IRS pro rata rule. The IRS pro rata rule is on IRAs, not 401ks. By cleaning up this money, doing the reverse rollover back into a 401k plan now opens the back door wide open for you to take that $5,000, put it into step one, the non-deductible, and then roll it over on day two to the backdoor Roth. It's nice, clean, and simple. Now, for a lot of people, the reverse rollover is the simplest fix. However, simple is not always strategic. Once those dollars are back in your current employer's 401k plan, essentially they're tied up until you either leave that job or you retire age 59 and a half for qualified distributions. You have less flexibility and access to these funds until there is some type of qualified triggering event. So before you think about option one, before you think about the reverse rollover, we're cruising, pump those frickin' brakes. And let's think about option two is Roth chunking. It's the more strategic play. Instead of avoiding conversions entirely, some individuals would want to intentionally convert, pay some tax now, and then never pay tax again once it's in Roth. The goal with Roth chunking is not to avoid tax, it's to manage tax. We're not playing checkers, we're playing chess. So let me explain. The tax scale is a sliding scale. We have 0 to 10, 10 to 12, 12 to 22, 22 to 24, 24 to 32, 32 to 35, 35 to 37. Now, if you can picture this on a line graph, we have some smaller jumps. We have 10 to 12. We have 22 to 24%. That's only 2%. And then as we get to the higher brackets, 32 to 35 to 37, small, but we're in the higher bracket. We don't really want to be playing around with Roth conversions there. We want to play around with Roth conversions in those little 2% margins. So we're not pushed above that. Where we want to avoid the Roth conversions is between the 12 to 22 and the 24 to 32. Those are big jumps. So essentially, let me back up. What are Roth conversions, Roth chunking? Let's go back to the original $100,000 that we had. We could essentially in one full swoop convert that $100,000 to Roth. Now that $100,000 might push us from the 24% tax bracket to the 32% tax bracket. So we're going to be paying tax on that full $100,000 at the 32% level, or maybe in the middle, depending on how far over you are. So we can either convert that entire 100 in one full sweep, rip the Band-Aid off, pay the tax, or we can strategically chunk at it year to year to year to year. Maybe in year one, we do 10,000. Next year, we do 15,000. The next year, we do 5,000. The next year, we do 25,000. But that's where we want to be strategic because we want to see where our income level is projected to fall. And then we can see how much more we can add on top before we push into the next tax bracket. So Roth chunking, it's a game. We're playing checkers. We are gradually moving money from the side that you got a tax deduction for, but you're going to be paying tax when you pull it out. So when we're pulling it out, we're paying tax, but it's going into Roth, which you'll never pay tax again. Here's my rule of thumb with Roth chunking. Let's say net, when you're doing that Roth conversion, you're doing that Roth chunking, you're going to pay an extra 8% in tax on top of what you would have paid, okay? 8%. When that money is in Roth, you're never going to pay tax on that again. So I want to hope that the money that I'm putting into that Roth bucket after that conversion is going to grow more than 8%. It's going to offset my tax liability for when I pull it out later on. So pay 8% now, maybe earn 10, 12, 15, 20% in it if you're self-directing. That's my hot take, my rule of thumb. Back to the originally scheduled broadcast program here for you folks. And again, let's convert up to our tax bracket. Hey, if we're in the 22% tax bracket, we don't want to go over that, and we have 10K to play around with before we're pushed into the 24%, then let's convert 10K. And Roth chunking is one of the most overlooked and underutilized strategies because it takes proactive tax planning. We need to be in an advisory relationship to do this. We need to be talking at least quarterly. And if you're someone that never wants to pay tax when you're retired ever again, then Roth chunking is the perfect solution for you. And the best times to do Roth chunking is those years where income is much lower than others. Maybe you're in between jobs. Maybe you're on the cusp of retiring. Maybe you were laid off. You're out of work. You're unemployed. Whenever your income, your taxable income at the IRA you're reporting to the IRS is significantly lower in years, Roth chunking, it's the right time to do it then. So we love Roth chunking. We love Roth conversions, but sometimes there are certain scenarios when it doesn't make sense. And this is what's overlooked by most advisors. So like I said before, if you're already in that top tax bracket, the 32, 35, 37%, let's put Roth chunking on the table on the back burner for now until our income might be lower in certain future years. Another reason, if you don't have enough liquid cash to actually pay the tax, let's say everything is in retirement or a lot of things are in brokerage, because if you're going to liquidate brokerage accounts, you're going to have to pay capital gain on that too, right? So if you don't have a lot of liquid cash on hand, all right, let's come up with a good plan to preserve cash flow. Maybe we have some debt. Let's pay down our debt. Let's go back to our personal financial statement, or who, what, where, when, why, how. Let's build that out. Let's see where our cash is and what we can utilize to fund the taxes on the Roth conversions. I know we're going to kick butt with it in Roth, and it's going to grow more than the tax that you actually paid. So in a nutshell, Roth chunking is an incredibly powerful tool, but it needs to be utilized the right way. We need to be strategic. We can't just make an impulse decision and rip the Band-Aid off, because if we do that, we are going to have a huge tax surprise come tax season. So quick recap. Roth IRA, Backdoor Roth, Roth conversions, Roth chunking. They are not all the same thing, but they are pieces on the same roadmap. Before you execute any of them, we need to remember the Pro Rata Rule, that one stingy rule that no one ever talks about that we're talking about on this video today, because one overlooked IRA rollover can completely change the tax outcome of what you thought was a clean move. So if you want to actually build Roth strategy that fits your income, your accounts, your long-term goals, then hey, that's exactly what we do here at Ledgerly. So link in the description, book a discovery call if you haven't already, and let's get a Roth strategy implemented for you. We'll see you on the next video.